One of the most frustrating things for investors is trying to figure out what causes a stock's price to rise and fall. It seems like every day a stock could easily be up or down a percentage point or two with no discernible reason. So in this video, I wanted to discuss exactly what causes a stock's price to rise and fall so you know exactly what to look for. And we're going to go over both the short-term and long-term factors. So on a day-to-day basis, short-term catalysts are one of the primary things that influences a stock's price. And positive catalysts can increase price on a day-to-day basis. And here are some of the most common positive catalysts. One is better than expected earnings or revenue, but that can only happen on an earnings call or during some sort of announcement that raises their projections. So this doesn't happen too often, but this is the primary reason why a stock might go up 5% or even 10% in a single day. Likely they've announced earnings and they were very good, better than expected. Another thing that could boost stock price is a new product announcement, especially for a company that's very product centric like Apple, or even like a pharmaceutical company. A new promising drug or tech product that looks exciting could easily raise stock price. Another thing that increases stock price on a temporary basis is a broker upgrade. And this is when a company like Fidelity or Morgan Stanley or something like that says that, oh, our price target for stock X has been raised $50 a share. And the reason that affects stock price so much is not because of people like you and me are following that advice, but rather money managers that manage retirement accounts and mutual funds and that sort of thing. When they work for a company like that, they're sort of bound to the price target. So if you worked for Morgan Stanley and you were, I don't know exactly how it works with Morgan Stanley, but it works at a lot of places. Some employees basically just invest based on the guidance of the company. So if the company thinks the stock price is going to go up, all the fund managers from that company that are invest in that stock are going to put more money into it. And the same thing goes for when brokers downgrades. That can cost the stock share price, but I'll discuss that a little bit later. Another thing that can boost stock price is bad news for competitors. So if you were, Chipotle, and Qdoba announced they were going out of business, that would be good for Chipotle. So as a result, the stock price might go up. One thing that can really drive the stock price up into double digits in a single day is a bid for acquisition. So when a smaller company gets a buyout offer, the stock price will go up because buyout offers almost always give a premium on the share price. So if a company buys out stock X for $30 a share, the stock was probably only like $24 a share to begin with. So everyone holding that stock makes 20%. And finally, the last thing that can really influence stocks on a day-to-day basis is new positive regulations or laws. For example, if it was a healthcare stock and a new law came out that expanded Medicaid coverage and that company did a lot of business through Medicaid, that could boost the share price as well. So there's also, all these factors have a reverse side that can lower the share price on a day-to-day basis. So worse than expected earnings or revenue, that can cause stock prices to really plummet. That's when you can see the double-digit losses is usually a big earnings miss. And if a company also can lose products just as easily as it can gain them, this is very common in the pharmaceutical industry where patents on new drugs will only last for so many years, at which point a generic can be, manufactured by a competitor and sold for $5 a refill or something like that. If the drug was a big moneymaker for the pharmaceutical company, that can cause major losses. And as discussed a little earlier, if a broker downgrades a stock and fund managers move money out of that stock, it can cause the stock to go down on, even just a single day, it can drop a couple percentage points. Likewise, while bad news for competitors is good for a stock, good news for competitors is sometimes bad for a stock. It's not always bad though, because sometimes if one company is doing good in a particular niche, it might mean that the overall niche is just very strong right now. It doesn't necessarily mean that the other side is doing poorly. But in something, so as an example of that, let's say a restaurant stock. Usually when one restaurant's doing good, all restaurants are doing good because it means people are eating out more. But in a direct competitive market where two competitors are selling the exact same product, sometimes if one competitor's doing very well and taking market share, that's like the main thing. It's not just total sales, it's actually market share. So if one company is gaining market share on another, that can hurt the stock that's losing out on market share. And failed acquisitions, so let's say a stock, people were thinking a stock would be bought out and that never came through. Once the acquisition was failed, the stock could precipitously drop with no other noticeable outside factor. Another thing that causes stock prices to drop is management changes. If suddenly the CEO of a company departs and the company was doing well, that's usually not a good sign. Same thing with anyone in the accounting department. When like a chief financial officer departs, that's not very, that's a negative catalyst. And just as a side note, management changes, we can also say that with management selling. So if executives are selling their stock, that's sometimes seen as a negative catalyst, but it's not always the case. So finally, there's lawsuits and new regulations and laws. If a company is being sued, that's never good, especially if it's sort of a class action lawsuit, particularly in the medical field. And also negative regulations and laws. This could be a drug getting banned. This could be a cut in Medicaid coverage. Anything like that that restricts a business's ability to make money is going to be seen as a negative catalyst. However, sometimes stocks change on a day-to-day basis, and there's no real visible catalyst for this. And there's really four reasons why this might happen. One is action from big players or money managers. Someone who's controlling a lot of money can influence stock price purely on a supply and demand basis. Let's say a particular investor wants to take $1 billion total stock purchase in a company. As they buy that stock, I'm sure they would spread that out over time just because they wouldn't be able to get enough shares in the first place. But as they're eating up that extra supply, that's going to drive the price up just from supply and demand. There's going to be less supply, and theoretically other investors will possess the same demand for that stock. So the price will go up slightly just from a big player buying a lot of stock. And the same goes for selling. If someone owns a large chunk of shares of a company and unloads them in a very short period of time, that could cause the stock price to tank. That's why you see stocks just down 2% in a day, and there's, nothing's wrong. The market's fine for the day. Nothing seems unusual. Nothing can be seen for why the stock could go down. It's just supply and demand. If a lot of people are buying on one day or a lot of people are selling on one day, the stock could go up or down. And there's another thing called a pullback. And this is common when a stock goes up a lot in price. It's common for it to, quote unquote, pull back or drop a couple percentage points before going up again. So let's say a stock had a really good quarter and the company slowly, over the next month, the stock went up 20%. It wouldn't be uncommon for that to drop 5 or 10%, sort of out of nowhere, until the next quarter came around and, good or bad numbers were announced, which could change the stock price up or down either way. And a pullback on the whole market level is called a market correction. Basically, this happens when a lot of people are putting money into the stock market and suddenly that money reverses direction. So let's say, the stock market as a whole, the S&P 500 has gone up 30% over the course of the year. It's not uncommon for it to suddenly drop like 4 or 5%. I mean, it doesn't happen often, but it could happen like once a year, once every couple of years. You'll see a major, what's called a market correction. And nothing's wrong with the stock in that case. It's just people are saying, hey, there's, we've put a lot of money in the stock market. It's good, but it's kind of expensive. Let's move out into bonds or something else. And it's just part of the game, If over a period of time, these market corrections and pullbacks are not going to affect your return if you just ride them out. And there's a final thing called a consolidation period. Basically, what a consolidation period is, after a stock's gone up in value a lot, it might just kind of trade sideways for a long period of time while it grows into its new market cap. So let's say a stock had a great quarter, and it went up like 50% over the course of the next couple months, just because people were thinking, oh wow, we're really bullish on this company's future. Let's buy this stock. Well, once it runs up that much and everyone that wants in is in, it might take a couple quarters for that stock to grow into its new valuation. That's just called a consolidation period. So, well, those are the day-to-day factors. What's really important if you want to make a good return is understanding what determines a stock price over a long period of time. And primarily this is earnings growth, and earnings guidance. And this can also be revenue depending on the stock instead of earnings. So basically, the more money a company makes, the faster it grows earnings. And if it projects fast growing earnings, those three factors are what's going to help a stock's price go up over a long period of time. As long as earnings continue to grow and earnings are high, the stock's price will continue to go up and up and up. And that really can affect growth companies. Already established companies that pay a dividend, earnings growth is important, but so is the amount that this earnings growth is able to translate into an increased dividend. So when a steady, like blue chip dividend stock like Johnson & Johnson or Procter & Gamble raises their dividend, that's a positive sign for the company, especially if the earnings are growing to support that said dividend. So another thing that can affect stock prices over a long period of time is Federal Reserve interest rates. Since the Federal Reserve interest rates have been so low for so long, the stock market is very highly valued right now because there's just nowhere else for investors to put their money to beat inflation. You have to be in the stock market because bonds and notes aren't paying any interest. If interest rates were to go up, then we might see some money start moving out of the stock market as a whole that has nothing to do with any company at all. And also, when Federal Reserve interest rates are low, companies borrow money to buy things. And that's especially common for companies that sell like business-to-business expensive products like construction equipment. When interest rates are low, theoretically people are more willing to buy houses, and businesses are more willing to borrow to buy equipment to build those houses. So companies like Caterpillar do very well when the interest rates are low, but they could start to see a decline in business as interest rates go up. So the state of economy as a whole also influences the stock market. When jobs growth and GDP growth is high, stocks do well. When things are sluggish, stocks can do poorly, as we saw in the 08 and 09 recession. But even when, job growth is slow, the stock market can still do well if you're picking individual stocks that are doing well. You might not do well being in the Dow or being in the S&P 500, but if you invested in a company like Apple in 2008, you would be doing just fine right now. So international events, things like crises in the Middle East that can affect oil prices and gas prices, that can change the stock price over a period of time. Local gas, oil drillers, they do well when there's crisis in the Middle East because they're able to sell their oil for more money, whereas like food places and things that rely on shipping, they do poorly when gas prices are high because it drives costs up. So like a restaurant stock that relies on its ingredients to be shipped in, it might not do well when there's very high gas prices. And finally, there's something called investor sentiment. It's basically just how the public at large and how the talking heads on the stock shows and the stock papers feel about a particular stock at a particular time. So let's say like a year ago, investor sentiment was very negative on Apple just because there was no new products. And as a result, the stock price was driven down from $700 to $400 a share. While there was major slowing of earnings growth that did contribute to that decline, the decline was definitely it was more than necessary. It was more than the numbers dictated, and that was the result of this poor investor sentiment. And now that sales are continuing well and investor sentiment is improving, the stock has gone up over time. So the bottom line is that day-to-day changes in stock price are not important and are often the result of just money moving into and out of certain stocks, just for no other reason than that's what the person who controlled that large amount of money happened to do on that particular day. The most important factor is earnings or revenue growth if you're looking to make a good return as a long investor. Long-term growth will always outweigh day-to-day negative catalysts over an extended period of time. So pick stocks that do well, that are able to continue to grow and make more money, and you too will make a good return. Just because you got to try to ignore the noise that drives stocks up and down on a day-to-day basis. Instead, take a long view. Like, how is this company going to be doing 5 years from now? If it's, they're going to have more locations, they're going to be selling more product, they're going to be making more money. And if it's a lot more, then that's a great investment. So I hope this video was helpful for you and you have a better understanding of why stocks go up and down over time.